Taiwan Semiconductor just posted the best quarter in its history. Record profit, guidance raised, the whole scorecard green, and Nvidia still closed the day painted red. Good morning, it's Friday, July 17th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks. Three of us again today. Grab your coffee because there's a lot on the desk, a chip sell-off that made a liar out of a genuinely great earnings report. Netflix and Alphabet both getting punished after hours for the same sin. UnitedHealth having the best day of any stock in the S&P, and an oil story that got a lot stranger overnight with a literal toll booth in the Strait of Hormuz. We've also got a scoreboard to settle, including a call from yesterday that came down to the wire. Eleanor, Marcus, let's start there.
4 wins, 3 losses, streaks at +2.
3 and 6, streaks -2. Let's just get to mine.
Not so fast. Eleanor, read your call back first because I want the listener to hear exactly what you said before we get to how it landed.
I said Nvidia closes red again yesterday, even with TSMC's number behind it. That if the best supplier beat in years couldn't flip the bellwether green by the closing bell, that's confirmation the fear trade in chips is bigger than any single earnings print.
And?
Nvidia closed at 206.77, down just under 2%. Red, same as the open.
And my side was the SOXX closes green, and Nvidia specifically closes up on the day. Neither happened. The whole semiconductor index finished down around 3% as a group. I was wrong in both directions at once, which is a genuinely impressive way to lose a bet.
You sounded so sure an hour after making the call.
I was. That's the part that stings. TSMC printed a genuinely great quarter, 36% revenue growth, margins up, guidance raised, and the market just didn't care. I thought a number that clean digests into a green tape by 4 o'clock. It didn't, not close.
I'll say this for you. You don't hedge the post-mortem. Some hosts would find a way to call that a draw.
It's not a draw. I lose that one clean. But I want to register now, on the record, that I don't think the market's right long term. I just think I had the wrong day for it.
We'll hold you to that. All right, on to the actual story because it's a good one. Eleanor, walk us through what TSMC actually reported because beat and still got sold undersells how good this number was.
It's TSMC's 5th straight quarter of record profit. Revenue was $40.2 billion, up 36% year over year, 12% from the prior quarter. Net profit jumped 77%. Gross margin 67.7%. Operating margin over 68%. Both up from the quarter before. And they didn't lower guidance, they raised it. Full-year revenue growth now guided to slightly above 40%, up from more than 30%.
Every single one of those numbers is a beat, and TSM still fell more than 4% and dragged Nvidia, AMD, Broadcom, and the whole memory complex down with it.
So what actually spooked the market if the results were this clean?
The bill? TSMC raised its 2026 capital spending guidance to $60 to $64 billion, up from $52 to $56. And their own third-quarter margin guidance, 56.5% to 58.5% operating margin, sits below the 60.3% they just posted. The company itself is telling you margins have already peaked for the cycle, right as the spending ramps.
Translate capex for someone who just hears a big number.
It's simple, really. Money spent building factories and equipment today shows up as a cost that gets spread out, depreciated over years to come. Spend more now, and you're committing to a bigger fixed bill in 27 and 28, regardless of whether AI demand is still there to pay for it by then.
Which I think is the wrong lens, respectfully. A company doesn't raise capex by $8 billion on a whim, they raise it because order books justify it. Hyperscalers are locking in multi-year capacity. Spending because demand is real is a completely different animal from spending to chase a story.
I don't disagree that the demand looks real today. I'm flagging that real today and still there in 28 when the depreciation bill comes due are two different claims, and the market just told you which one it's pricing more cautiously.
And this wasn't just a US story. Asia had an ugly night that fed right into it.
Rough one. South Korea's Kospi fell 6.6% overnight, its worst session in months, after the Bank of Korea delivered a surprise rate hike, its first since 2023, explicitly to get ahead of war-driven inflation. SK Hynix dropped more than 11%, Samsung over 8%, Japan's Nikkei slid almost 3%.
A central bank hiking into a war, not cutting. That's the opposite of what most of the world's doing right now.
And it's a legitimate move, even if it looks jarring. Oil-driven inflation shows up on a headline CPI print looking identical to demand-driven inflation, even though the honest policy response is completely different. The Bank of Korea's betting the Hormuz story doesn't cool off soon, so they moved first.
Give me the tell then. What turns this from a Korea-specific overreaction into something that actually threatens U.S. chip names for more than a news cycle?
Nvidia and AMD trading down on good supplier news repeatedly for more than a couple of sessions, same test we set up yesterday, and it just failed for you again this morning. Futures have the Nasdaq underperforming again into the open.
Zoom out to the actual index level for a second. How bad was yesterday, really?
Nasdaq Composite down 1.47%, worst of the majors. S&P 500 off about 0.5%. Dow basically flat, down 0.3%, because it's got less chip lead and more of the healthcare strength we'll get to. And the Russell 2000, small caps, actually gained 0.3%, money rotating out of megacap tech into names with less AI capex exposure.
Which is its own signal. It's not sell everything, it's sell this one specific, very crowded trade. VX only climbed into the mid-16s, up about 4% elevated, not panicked.
So today's the third data point, not the last word. Let's move Netflix and Alphabet, because after the bell last night, two of the market's favorite growth stories both got taken to the woodshed for the exact same reason.
Same sin, different stock. Netflix actually beat $12.56 billion in revenue, 80 cents a share against the 79-cent estimate, clean beat on the quarter that just happened.
And the stock fell more than 8.5% after hours anyway, down to around $68 from a $74 close, a fresh 52-week low. Because the guidance was soft. Third quarter revenue guided to $12.86 billion against a street number closer to 13. Full year range narrowed and narrowed down, not up.
Devil's advocate for both of you, the quarter that just happened was fine. Isn't punishing a stock 9% for a guidance number that's still growth, just slightly slower growth, an overreaction?
Normally I'd take that side of the argument. Not this time. This is the third or fourth quarter running where Netflix clears the number that just happened and misses the one that's coming. At some point, a pattern is the data, not noise around it.
Agreed. And I'd add, this is a market that stopped rewarding "we beat" and started demanding, and here's proof it keeps compounding. Alphabet got the same treatment in the regular session, down 4.4%, over $200 billion of market cap gone, on a Bloomberg report that Gemini 3.5 Pro has missed its third straight launch deadline and slipped again, with a wave of senior DeepMind departures on top of it.
So it's not just one company's subscriber math. It's a mood.
Right. Streaming and AI infrastructure are two of the highest conviction growth stories in this market, and both got marked down in the same evening, not because the current quarter was bad, but because the forward math didn't clear a high bar. Layer that on TSMC's bigger capex bill from this afternoon, and the through line for the whole day is a market that wants proof the spending converts into durable future earnings, not just a good headline.
I'll take the other side of one piece of it, though. Alphabet getting hit for a model delay feels more like company-specific execution risk than a read on the whole AI trade. A 3-month slip on one product isn't the same signal as Netflix guiding down for the fourth quarter running.
Does this bleed into the rest of streaming and media today, or is it contained to the two names?
Worth watching at the open, Netflix's guidance miss usually pulls in sympathy moves from the rest of the group, since the market reads it as a signal on subscriber growth and content spend leverage industry-wide, not just one company's forecast.
Fair distinction. All right, before we get to the next story, I need 30 seconds, because it's Friday and I earned it.
Go ahead.
I finally cleaned the coffee off my kitchen counter from Wednesday's incident. Took until this morning. There's nothing more humbling than mopping up your own mistake for the second day in a row.
Micron's had a better week than your kitchen.
Low bar, but fair. Okay, back to the tape and to a stock that had the opposite kind of day, UnitedHealth.
Biggest single stock mover in the entire S&P 500 yesterday, up as much as 8.7%. Adjusted earnings of $6.38 a share against a street estimate closer to $4.90, that's roughly a 30% beat. And it's the second straight quarter they've raised full-year guidance, now $19.50 to $20 a share.
On a stock that spent a year and a half in the penalty box after last year's Medicare Advantage cost blow-up. This is the clearest sign yet. The turnaround's actually real.
Give me the mechanism. How do you go from a disaster to a 30% beat in 18 months?
Discipline, not demand. Revenue was basically flat. What moved was the medical care ratio. Plain terms, that's the share of premium dollars UnitedHealth pays back out in claims. It improved to 86.7% from 89.4% a year ago. And a big chunk of that came from walking away from about 1.1 million unprofitable Medicare Advantage members and roughly 500,000 ACA exchange members. They didn't get better at pricing risk broadly. They got smaller on purpose.
Which I'd argue is still a real result. Optum, the services arm, grew earnings to $4 billion, margin up 160 basis points, serving over 120 million people. That's not just pruning the book. That's the other half of the company scaling.
I'll grant Optum's genuine. But the insurance side's own CFO said on the call that this reflects deliberate cost-cutting, not a reversal in underlying medical cost trend industry-wide. Shrinking the membership base by 1.6 million combined lives means next year's growth has to come from repricing the smaller book you kept, not adding new premium dollars. That's a shorter runway than growth-led earnings.
What would change your mind on that, Eleanor? What would tell you the ratio improvement is durable, not just a one-time prune?
The medical care ratio holding or improving further in the third quarter without another big round of membership cuts behind it. If it reverts back up once the easy exits are done, that tells you the underlying cost trend never actually bent.
And Humana and CVS both traded up in sympathy yesterday, which tells you the market thinks this is a sector story, not a UnitedHealth-only story. Elevance's own benefit-expense ratio was 89.7 in their print a few days ago, meaningfully worse than UnitedHealth's 86.7. Watch that gap. If it keeps widening, that's Eleanor's caution proven wrong company by company.
Was it just UnitedHealth carrying the sector, or was this broader?
Broader. Actually, that's part of why I take the print seriously. DexCom gained about 7% on top of a recent Health Canada approval for its longer-wear glucose monitor, and Abbott advanced after beating estimates and lifting its own 2026 earnings outlook. 3 separate healthcare names, 3 separate beats. On the same day, chips couldn't buy a green print anywhere.
Healthcare doing the heavy lifting while tech drags the index. That's a rotation story as much as it's a UnitedHealth story.
A genuine bright spot in an ugly tape, and a real test of whether the turnaround has legs. Let's get to the story that got a lot stranger overnight. Oil and the Strait of Hormuz.
Brent sitting around $84, $85, a fourth straight session higher, and it picked up a new wrinkle overnight. The administration's framing the naval blockade as a toll, not a closure, reportedly charging a 20% fee on all cargo shipped through the strait, with the president calling the U.S. the, quote, guardian of Hormuz.
And it's working in the sense that traffic's actually collapsing. Reports have just 6 vessels tracked crossing the strait between Thursday and Friday, against 18 to 22 a day earlier this month. That's not a headline risk premium anymore. That's real, physical cargo not moving.
So which is it? Is oil, sitting in the mid-80s, underpricing an actual supply choke, or overpricing a toll booth that mostly just gets paid?
I think it's underpricing it, and I'll make the case plainly. A drop from 20 daily crossings to 6 is an 80% to plus collapse in traffic to a strait that carries over a fifth of the world's oil trade. If that holds for even another week, you don't stay in the mid-80s. You're testing the triple digits we haven't seen in years. The market hasn't caught up to how physical this has gotten.
I'd push back hard on that one, actually, and this is where I think we genuinely disagree, not just hedge at each other. A toll is a price, not a wall. If shippers can pay 20% and keep moving, that's a cost that gets passed through to buyers, not a supply cut. Traffic being down doesn't necessarily mean oil's not flowing. It could mean it's being rerouted, insured differently, or just delayed while operators figure out the new math. Brent, sitting in the mid-80s instead of spiking, is the market telling you it thinks this gets absorbed, not that it's asleep at the wheel.
A toll only works as just a cost if enough shippers are willing to pay it and keep sailing. 6 vessels in 2 days tells me most of them aren't. They're waiting, rerouting around Africa, or sitting in port. That's not a rerouting story at that magnitude. That's a stoppage with a friendly name.
We're not going to settle this one this morning, and I don't think we should pretend to. Watch the tanker count over the next few sessions. If it stays in single digits, Eleanor's right and this gets a lot more expensive fast. If it climbs back toward the teens as shippers adjust to the fee, I'm right, and Brent stays roughly where it is.
That's the split, and I'm not picking a side for you. Watch the vessel count, not just the Brent print, over the next few days. Meanwhile, gold did something odd on top of all this. It slid toward $4,000 an ounce even as oil climbed, which is usually the opposite of how a Middle East scare trades.
That divergence is the real tell of the day, honestly. An oil shock is supposed to be a safe haven trigger for gold. Instead, the move higher in oil is reinforcing a stickier inflation, less room to cut story for the Fed, which pushes real yields up and pulls gold down. That's a stagflation-flavored read, not a clean flight to quality one.
And copper's telling its own, completely separate story underneath both of those. Up almost 1%, 16% over the past year, and that's got nothing to do with the Middle East. That's a 15% tariff on refined copper imports reportedly starting January 2027, with inventories already stockpiling at a record pace ahead of it.
And there's a fourth wrinkle nobody's talking about. Natural gas is doing the opposite of oil. Henry Hub sitting near a 2-month low because domestic output's up and Freeport LNG's export terminal is offline for maintenance, bottling up supply at home. So the energy story isn't uniformly bullish. It's a genuine split between the piece that's geopolitically exposed and the piece that isn't.
4 commodities, 4 different stories, all moving the same morning. Let's turn to today because there's real data on top of all of this. Eleanor, what's on the calendar?
Housing starts, building permits, and industrial production all land at 8:30. That's against 30-year mortgage rates sitting near 6.55%, the highest in almost a year. So don't expect a strong starts number. The financing backdrop is working against it. Then at 10, University of Michigan consumer sentiment, preliminary July read, expected to tick up to roughly 50.7 from 49.5. Still near historic lows even if it improves.
And earnings before the bell are stacked again. Travelers, Truist Financial, and Fifth Third Bancorp on the bank and insurance side, plus American Express, Charles Schwab, 3M, and Schlumberger. That's a real cross-section. Consumer credit, industrials, energy services, all reporting before lunch.
A lot to digest on a Friday.
And futures are already leaning into it. Nasdaq 100 futures down about 0.3% into the open. Chip weight again, same story as yesterday, just one more morning of it.
Any read-through from yesterday's retail sales number into today's sentiment data?
A little. June retail sales came in soft yesterday, up 0.2 against a 0.3 consensus. Not alarming on its own, but it's the same direction as the Michigan number we're about to get. If sentiment disappoints on top of that, the is the consumer actually fine question gets louder, especially with oil and mortgage rates both elevated at the same time.
One more thing before we close it out. PayPal, any movement?
Not yet. The board's expected to respond to the Stripe Advent bid as soon as Monday, so nothing new to score today, but that's the one to watch heading into next week, especially with today being the month's biggest options expiration.
Noted. We'll pick it back up Monday. All right, closing calls, one specific, checkable thing each for today's close.
Brent crude closes above $86 today. If the vessel count stays this depressed, the physical squeeze shows up in the price before the day's out, not next week.
And Marcus, you're making almost the same bet you just lost an hour ago.
I am, and I know how that sounds. Suggs closes green today. 2 ugly sessions on a genuinely great TSMC number is an overreaction, and I think it starts correcting today, not next week. I was early yesterday. I don't think I'm wrong on the direction.
We'll know by 4 o'clock whether early holds up twice in a row. So here's today, Watch the tanker count out of Hormuz as much as the oil price itself. Watch whether chips actually catch a bid or make it 3 red sessions running, and keep an eye on that Michigan sentiment number against the 6.5% mortgage rates. If the show helps you start your morning, follow Nova Ventures Daily wherever you get your podcasts, and you can find our full written notes at novaventures.us. That's your Nova Ventures morning brief. Have a great Friday, and we'll see you next time.